Hi students, welcome back. We were discussing about the different capital budgeting techniques. Before that, we have discussed the payback period, we have discussed the net present value, also the accounting rate of return. In this session, what we are going to discuss, we are going to discuss the profitability index. Profitability index, or simply it is called as the PI. What is the formula for the profitability index or the PI? It is simply the present value of all the inflows. Means you have a different inflows, but we have to calculate the present value of all the inflows. Then we have to divide it with the present value of the outflows. Mean there is an outflow and then there's a inflow. What we have to do, simply the present value of inflows should be divided by the present values of the outflows. Now what is the present value over here? Let's see that we have one project which has a total outflow of how much? That is the 60,000, and the life of the project is how much? That is 4 years. So it has a 4-year inflow, like a 20,000 equal amounts are coming for the next 4 years. So for the simplicity, we are taking a very same values here. So 20,000, 20,000, 2020. So these are the inflows for the next 4 years. Now what we have to do, we have some specific accounting rate of return, we have some required rate of return, we have some cost of capital. So the different return rates are available. So normally the cost of the capital or the required rate or the simply the discount rate what we are using here. So let's say that we are using the 12% discount rate or the required rate of return. So what we will do, we will discount all these values. We will see the present value of this 20,000, 20 for the year end of 1, 2, 3 and 4. So now what is the value? What we are getting now here is 20,000 after 1 year. But what is the present value of that? If we discount it at a 12%, so the answer will be 17,857. Same if we are discounting it for the 2 years, so the answer is 15,000, for the 3 year 14,000, for the 4 year 12,000. So if we get the total of this thing, so it is 60,747 approximately. So these are the inflows. So if we total the inflow, the present value of the inflow, how much is that? That is 60,747. And what is the outflow? The present value of the outflow is how much? That is 60,000. Simply what we have to do, we have to divide this thing. So 60,747 divided by 60,000. So the answer is almost that we have 1.012. So this is the profitability index. So how we decide that either we have to accept the project or we have to reject the project? So if the answer is above 1 means that we are getting exactly 12%. But if the answer is above 1, sorry, so it means we are getting more than 12%. So the profitability index is saying that it is 1.012. So answer is obviously above 1. So we have to accept the project. Let's say for the same project, the required rate of return for any other company is, let's say, 17%. So what we have to do, we will do the calculation, same calculations, but we are using this 17% rate. So for the 17%, 20,000 has a present value 17,000, 20,000 is 14,000, 20,000 present value 12, and then 20,000 has a 10,000. If we get the total over here, so total is 54,864. If you see here, when we are increasing the discount rate, automatically the present value is decreasing. And now if we calculate the profitability index for this, so 54,864 divided by 60,000. So the answer here that we are getting is 0.914. So 0.914 means what? It means we are not getting our required rate of return of 17%. So the what we are getting is less than 17%, but our required rate, our discount rate is how much? 17%. So the answer is less than 1. It means what we have to do, we have to reject this project if our required rate of return is 17%. But if our required rate of return is, let's say, 12% or even less than that, means this project should be accepted. So this is the concept of the profitability index, that how it is calculated and how we have to make the decision related to that. How these present values are calculated, these we have already discussed in the previous lectures, that what is the present value, how we are compounding and how we are discounting it over the year. So for this purpose you can refer back to the previous lectures. I hope you have understood the concepts, but still if you have any confusion, any doubt, you can ask me in the comments section. Thank you very much.